Hello to all of our viewers. My name is David McGann. I'm a director here at BMO InvestorLine, and I'm thrilled to be co-hosting today's webinar, which is an introduction to index options trading. This comes to you as part of our webinar series that seeks to unpack options trading. Be sure to check out our education hub to find other webinars in the series that may be of interest to you. Once again, we'll be joined here with our friends at OptionsPlay, and I'm pleased to introduce Tony Zhang. Tony is Chief Strategist at OptionsPlay, where he leads development of options trading products, education for investors, and oversees the firm's quantitative options research. He is a frequent contributor to CNBC for analysis on the markets with a specific lens using technical analysis, fundamentals, and of course, options. We're pleased to have Tony back, and I know we have some great content to review today with index options trading, Tony. And with that, I'll hand things over to you.
Thank you so much, David, and thank you so much for everyone for joining us today. As David said, we are going to be covering the introduction on index options trading today, a very common type of options contract that can be traded in North America. So today what we really want to make sure is dive into the specifications of an index options contract, how they might be different from some of the other products that you are used to trading, and making sure that you understand how to utilize some of these products and the different types of products that are available for trading when it comes to index options. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using today as example purposes. So let's take a look at what we are going to cover during today's session. First, before we jump into the options side of things, we want to discuss what is an index versus an ETF. Understanding what the key differences between these two are going to help you better understand the differences when it comes to the options contracts themselves. Then we'll dive into looking at index options and ETF options. We'll be looking at the difference in terms of contract specifications and what the difference will be to you as a trader of these two types of option contracts that on the surface might seem very similar, but when we dive into the details, there's actually quite a bit of difference between these types of contracts. And to understand those differences of those contracts, one of the key features is understanding the difference between an American style versus European style options. We'll take a look at which one is which and what the differences are. And then we'll discuss kind of what are some of the potential benefits of trading index options versus what limitations you might have when you're trading index options. And then to help you better understand this, we'll take a look at the NASDAQ 100 index options complex, meaning the different types of products that are available, and then take a look at a sample trade to help you better understand the differences in some of the contract specifications that we're talking about during today's session. So let's kick this off by taking a look at what is an index. Now, at this stage, I think many of you that are viewing this probably have a good sense for what an index is, but let's just review that very quickly. First of all, when we refer to an index, this is simply just a calculation. It's a method to calculate and track a basket of securities to measure the performance of a group of assets. Now, many of you may be familiar with some of the more popular indices that are available that we use to track different segments of the economy, whether that's the S&P 500 to track the broad-based US equity markets, or if you want to look at something a little bit more specific, such as the NASDAQ 100 or the Russell 2000 that tracks either technology-focused stocks or small-cap stocks. There are thousands and thousands of indices that track different slices and dices of the economy and the market, but they really provide you a performance of how those specific slices of the market is doing from a price perspective. And one of the key things to remember is that these are simply just calculations, meaning they are nothing other than a formula. And indices, while widely tracked, the indices themselves are actually not tradable. You cannot trade an index itself. You can only use them as a way to track the performance of a group of assets or a way to slice the overall market. Now, That doesn't mean that many of us wouldn't want to trade some of these indices, such as the S&P 500 and the NASDAQ or the Russell 2000. And that's really why the invention of an ETF is such a popular tradable product these days, because an ETF gives us an instrument that can actually trade a basket of securities that can be bought or sold on an exchange that tracks these popular indices that we all use on a daily basis when we're trading the markets to gauge the performance of the markets. So as I said before, the S&P 500 or the NASDAQ 100, some of the most widely tracked indices, there are many times dozens of ETFs that are listed that track a single index. These could be different providers, these could be different fee models, but they're all doing the same thing to help you try to track the basket of securities that you can actually trade in a vehicle called an ETF. Now, ETFs are very similar to mutual funds from the perspective of they can be traded to track these baskets of securities, but the difference between ETF versus a mutual fund is that you can trade them intraday, unlike a mutual fund where you can only trade them once a day after the close. And like I said, these are typically tracking some of the most widely tracked indices, such as the S&P 500 or the NASDAQ 100, but there are actually hundreds of ETFs that you can track, because there are thousands of indices that track different assets. There are hundreds of ETFs that are listed that allow you to track different trade different segments of the market. There are sector ETFs that allow you to track specific sectors. There are ETFs that allow you to track specific currencies or specific commodities. So pretty much anything that you can imagine in terms of how you would like to gain exposure to different segments of the market, chances are there is an ETF listed that allows you to gain specific exposure to a specific slice of the overall market. So that's the evolution that we're going to look at, is indices versus ETFs, and looking at the options that are listed on these two types of products. So in order to understand that, I think the best thing to first understand is the difference between two different types of option contracts. That's American style options and then European style options, because many of us that might be trading options are probably more commonly aware of what we consider American style options, because most ETF and stock options are what we call American style options. That means they are exercisable up until the expiration date. You can exercise them at any time before or on expiration date, versus index options are what we call European style, or typically European style. That means that options for index options are typically only exercisable at expiration. So let's take a step back and think about these two different products. When we talk about ETF and stock options, those are very similar to each other. These are all for physical delivery. What that means is that each option contract gives the buyer the right to either buy or sell the underlying stock or ETF, depending on whether it's a call or a put. And at expiration, or on any time before or at expiration, that buyer can choose to exercise their rights and either buy or sell the underlying shares. However, with an index option, these are all options listed on an index by an exchange directly on the index value themselves, and these are cash settled options, which means that even though you can only exercise them at expiration, if you do choose to exercise them as the buyer, you don't actually get delivery or have to take delivery of the underlying security, because in this particular case, an index, as we said before, is not a tradable product, which means that at expiration, if you choose to exercise your call or a put, then whatever profits and losses you would have from that exercise, you would actually gain or lose that in cash, which is what we call cash settled options. So ETF and stock options are what we call physical delivery American style options, and index options are cash settled European options. And the difference is both in terms of how they're settled, as well as what your choice, as well as when you can choose to exercise these options, either at expiration or either on or before expiration. Now, diving even further into the specifications of these contracts, because these details, while seemingly detailed in nature, make a pretty big difference when it comes to trading these contracts. So it's really important that you read the fine print when you're trading these types of contracts and understand the legal ramifications that you have when you're trading these types of products. So the next thing I want to talk about are settlement, right? We talked about the fact that ETF and stock options are physically settled versus cash settled for index options. But one of the things that I think a lot of stock and ETF traders are used to are what we call PN settlement. That means an option contract expires based on the closing price on the day of the expiration date. Meaning, if let's say you traded a contract that expires on April 21st, then the settlement of that option is based on the closing price on that day, which is typical for a lot of options contracts that are traded. However, when you're trading index options, while most index options are also PM settled, there are some option contracts, index option contracts, that are what we call AM settled. And what that means is that they are actually settled based on not the closing price of that day, but the opening price of that day. And this is interesting because you actually can't trade these contracts past the closing of the previous day than the expiration date. So if an option expires on the 21st, the last trading day is actually the 20th. And however, even though the last day you can trade it is on the 20th, the option contracts aren't settled until the very next day. And we're going to look at an example of this to help you better understand that. And I know that that sounds very confusing for a lot of traders because you have to determine when you can last trade it based on the expiration date. But we'll go through an example and help you better understand that, because that is one of the key, I would say, a critical difference between ETF versus index options that a lot of traders should be aware of before they start trading their first index option. And then lastly, when we talk about stock or ETF options, we're used to option contracts referring to 100 shares of the underlying stock or ETF. And when we're trading stock or ETF options, that is the case. But when we're trading index options, because there are no underlying shares or instruments that you can trade, an index option simply represents typically the index value multiplied with a 100 multiplier. So if you have a $5,000 index value, you would multiply that for 500, and that would mean that you would have a notional value of that contract of $500,000. And this is something we're going to take a look at some examples as to how to calculate the P&L of an index option based on that $100 multiplier. And not all index options have a 100 multiplier, so it's important that you do your homework and take a look at the different specifications of the contracts that you are trading and exactly what multiplier you have to apply in order to understand the P&L potential of the option contracts that you're trading.
Tony, I'm going to jump in here. You've done an incredible job here to unpack a lot on really some of the key differences with index options, the fact that they're European style, where ETF options that might still be tracking the same indices are American style. And so why would some traders select index options versus ETF options, or vice versa, to execute their trading strategy? Like, what are some of the drivers or motivations with making this decision or this choice? Can you expand on that a little bit?
Yeah, absolutely, David, and thank you so much. And you're absolutely right. We've gone over a lot of details and a lot of what we consider really as kind of almost legal jargon, right? Because it really is the fine print of the legal contract that the buyer and seller is engaging in when they're buying or selling one of these contracts. So to kind of help answer your question, I think there are a few different reasons why traders might gravitate towards an index option. And a lot of it is embedded into what we call that European style cash settled nature of index options. And I will say that typically option sellers, if you're selling options, even if just one of the leg of your option strategy has an options, is short an option, I would say that a lot of traders prefer the index options route, because when you're short an option and you're short an European style option, you don't have what we call early assignment risk. So you'll never be in a position where, let's say you've sold a credit spread or any other type of strategy, or even just you sold a simple put option on an index. You won't have a surprise early expiration because those options can't be exercised early. They can only be exercised at expiration. And if you do end up being assigned on a short call or a short put, you don't have to worry about having the capital to be long 100 shares of the underlying stock or short 100 shares of the stock. You just need to have the difference in terms of P&L in your account to settle that transaction. So for those reasons, I tend to find that for a lot of traders that are selling options or have a component of their strategy as selling options, the index options just makes the transaction cleaner, and they don't have to worry about early exercise or needing the cash if they do get assigned on that short leg of the option. On the ETF side, and we'll discuss this a little bit more on some of the other slides, it really comes down to flexibility. ETFs many times, number one, give you different types of exposure that you may not be able to get from an index option, because there are not many index options that are necessarily listed. There are a lot more ETFs that you can trade, so you simply just have the ability to get direct exposure to very specific slices of the market that the ETF options provide you, that the index options complex may not provide, and also sizing. ETF options tend to have a lot more flexibility when it comes to sizing. So I think for a lot of retail traders, that is an important component to selecting those types of products for their portfolios over the index options. But we will take a look at how the index options world is evolving to fit the needs of retail traders from that last point, and it kind of closes the gap a little bit in certain areas as well. So with that, let's take a look at further kind of the difference between American versus European style options, which we've already spoken about a little bit in the previous slide. So like I said, most ETF options are what we consider American style versus index options are European, which means that the buyer has the right to exercise at any time prior to expiration for that American style ETF option, versus the European options can only be exercised at expiration. And this means that, when we're thinking about these types of transactions, when we're trading stock or ETF options, only in the money options are subject to auto exercise at expiration, versus the European style ones are simply cash settled. You don't need shares or securities to be exchanged between the buyer and seller. The option seller doesn't have to worry about needing the margin requirements to be long or short the security or potentially be liquidated. It's just a clean transaction at the end. So whatever the P&L of the trade at expiration, that is just simply debited or credited into your account, versus the stock or ETF option trader has to worry about either taking physical delivery or needing to buy or sell that specific stock or ETF in their underlying portfolio, which makes it quite a bit more complicated, especially if you're trading a strategy and you had no intentions of owning the underlying security. So it just adds a lot of complications, and many traders have to avoid those complications by closing out a trade well before expiration or well before the expiry date in order to avoid some of those risks. So those are some of the things that index options don't really have to worry about. They can simply hold on to an option strategy, no matter, even if they're trading complex strategies with multiple short legs. They don't have to worry about kind of what are the risks with each leg of being assigned early, and they can just hold it to expiration, knowing that at the end it'll just be cash settled in their accounts. We did mention previously that Those American style options are typically PM settled, which makes it, from my perspective, a lot easier to remember when to close out a trade or when you might want to manage a trade versus some index options. And there's not many in terms of options expirations, but some of them are AM settled. Some of the more popular expirations are AM settled. And this is one that I think has caught some traders off guard, especially those who weren't paying attention to the fine print. And that can be confusing of when is the actual last date that you can trade in AM settled options, and what risks do you have to take based on holding some of those contracts to expiration. Because like I said, those American styles that are PM settled, you can hold them all the way through the closing price of the expiration date. But on the European style index options, you can only, the last tradable date is actually the night before the expiration date. And that can be really confusing for some traders. So I actually tell a lot of retail traders that are trading these types of index options just to avoid the AM settled options altogether, to avoid what we call overnight risk. And we're going to take a look at an example of that here in a few minutes to help you better understand what overnight risk involves and when and how you can actually manage some of those trades if you were to trade an AM settled index option. So this sort of helps also, answers that question that Dave was asking us before, is understanding kind of some of the benefits of trading index options versus what limitations you might have in place when you are trading these types of products. Now, don't get me wrong, when we talk about index options in terms of sheer volume, out of the entire options market, index options account for a very large percentage, even though they represent a very small few contracts of the overall listed contracts that are available for trading. So they are immensely commonly traded when it comes to index options. So some of the key benefits, like I said before, is really the fact that they're cash settled and they're European style. And this tends to favor option sellers, because sellers generally want to avoid early assignment. They don't want to, in the middle of an option contract prior to expiration, be forced to own or be short an underlying security. Index options effectively eliminates that risk altogether. And even at expiration, as you're holding one of these contracts to expiration, if you're trading an American style option that are physically delivered, even if you have an option that's approaching expiration that's out of the money, you still have some risk that the buyer of that option could exercise an option even if it's out of the money at expiration. So when you're trading index options, you effectively eliminate early assignment risk and exercise risk altogether. And that's really attractive, I think, for a lot of traders that prefer either purely option selling, or there's a component of your option strategy that is short an option and to avoid those risks. And I think that's really key for traders that are trading index options themselves. Now, in addition to that, like I said, these are some of the most commonly traded products in the world. So if you think about in the US, we list over 1 million strikes across nearly 6,000 securities that are optionable, with 1 million plus strikes that are available for trading. Index options represents a very small percentage of the 1 million plus strikes that are available for trading, or the 1 million plus option contracts that are available for trading. Yet they account for some of a very large percentage of the overall volume that's traded. And that really speaks to the deep liquidity that's offered from from many of the index options that you can trade. And we're talking about some of the most popular and most widely tracked indices, such as the S&P 500, the NASDAQ 100, the Russell 2000, the VIX, these types of very, very popular indices that we speak almost on a daily basis when we think about the performance of the market. The index options that are listed on those products are some of the most liquid and widely tracked indices, which means that, number one, you can trade them with a fair amount of certainty that liquidity will not be a problem as a retail trader, because many of these option contracts have billions of notional value that's traded every single day. So plenty of liquidity. And because of how widely tracked these indices are, they are also offer a very, very large number of expiration dates and strike prices. So if you think about, how far out you'd like to trade, what percentage, out of the money, or what delta you specifically like to use for strike prices. From my perspective, there is no other products that provide such a wide range of different expiration dates and strike prices that you'll almost always be able to find an exact expiration date and strike price that you prefer to trade when you're trading these index options versus stock or ETF options, where you might not have as many choices of expiration dates and strike prices, and you might have to approximate, close to what you're looking to trade. So these index options, because of how widely tracked they are and how widely they're traded, offer such a large variety of expiration dates and strike prices that for a lot of traders that really like to fine tune their trading, they can find almost the exact expiration date and strike price they're looking for. On the flip side, there are not many indices that actually offer index options. There are only about 50 in the US markets. Out of roughly 6,000 optionable securities, we're talking about less than 1% of them are index options. So that is something to consider, that there are not many options when it comes to index options. So you really have the popular indices such as the S&P 500, the Dow, the NASDAQ, the Russell, and maybe the VIX is really, the extent of which the major indices that you can trade index options on. There are some in Canada that you can trade as well, but that is sort of the extent of the deep liquidity index options that are available for trading. So you just don't have a wide selection of indices that you can trade these types of contracts on. And contract sizes for these types of index options tend to be more suitable for institutional traders than retail traders. And we'll take a look at how exchanges are trying to deal with this problem by providing contract sizes that are smaller, better suited for retail traders. But when we talk about the contracts that are most liquid, these are the big contracts. These are many times $500,000 or $1.5 million contracts in terms of notional value. So they are typically for clients who have a larger account, or perhaps institutional traders. Many times that these index options provide these benefits. But like I said, there are changes that the exchanges are making to try to fit more of these products and make them available for retail traders.
Tony, I'm going to jump in again, and thank you. I mean, like I said in the previous slide or so, lots to unpack with index options. And I think one of the big takeaways here, and I know we have folks in our audience that are very much income focused and looking to generate income with their portfolios. And I do, want to build a bit on what you said, that index options and the fact that they are European style, meaning there isn't that risk of early assignment, means that strategies like credit spreads that are typically, focused on income generation, make index options a great potential vehicle to explore. So I think that's great. I think you've done a wonderful job to unpack that. I've got a couple of questions for you here, Tony. You touched on this a bit already, but I just want to open it up one more time. You mentioned the fact, so number one, you mentioned the fact that there are about 50 indices in the US that have index options listed. Like I said, you touched on this a bit, but do you find that there's high demand and liquidity across the board, or is index option trading mostly concentrated across a short list of indices?
That's a really great question. And the short answer to your question is that we see this across the entire options market, not just in index options, but liquidity is very concentrated in the top few names. So we're really talking about the S&P 500, the NASDAQ 100, a little bit of the Russell, but those are really where the liquidity is concentrated in those three index options. So out of the 50 that are listed, those three probably take 70 to 80% of the notional volume that's traded across all index options. The same way the top 10 equity names probably account for about 50% of the total volume of the U.S. equity, U.S. options markets. So those are there is concentration across the top names, even in the index options as well.
Okay, great. And so, number two here, Tony, is, we've been primarily focused a bit with some of the examples on talking about US index options. And so similarly, is there demand and liquidity with Canadian index options, or do we find that it pales in comparison to what we see south of the border with US indices?
Yeah, that's a great question. In Canada, we see two primary index options that are listed. One that is on the S&P 60 TSX index, as well as a US dollar based index option, and both of which are traded, but in terms of liquidity, it really pales in comparison to the US markets. But there are two index options that are available for trading in Canada that offer many of the similar benefits, but in terms of liquidity, it's not the same as the S&P or the Nasdaq 100 here south of the border.
Yeah, I think that's really helpful for our audience to note, right? And obviously, with less liquidity, probably means wider bid-ask spreads, right? And challenging to get fills, both getting into positions and then, of course, getting out. So that's great insights, Tony. Thank you. Appreciate you addressing those questions.
Yeah, absolutely. And I will say that, but one of the things that we have noticed in some of these index options is that sometimes these index options can have what on the surface looks like fairly wide bid-ask spreads. But when we look at executions, we actually see most of them are executed very close to the midpoint, even though the bid and offer that's quoted on your screens are quite wide. And that's something that we have to take into account when we're trading these types of products, because when we talk about the NASDAQ 100, for example, we are still talking about a product that trades billions of dollars in notional volume, but the bid-ask spreads on the screens look fairly wide, even though when we look at the executions, most of those executions actually happen within just a few percentage points of the midpoint, nowhere near kind of where the bid-ask quotes are quoted. So those are some of the things that I think traders should be aware of before they step into index options. But great question. So moving on, like I said, one of the biggest challenges for index options is the sizing of the contracts themselves. And I think this is especially acute when you look at popular indices such as the NASDAQ 100 index, because the NASDAQ 100 index at the moment is priced somewhere around 15,000 dollars in terms of the index value. Actually, we've seen it top out around 18,000 in terms of the index itself, which means that at the peak, an $18,000 index is a $1.8 million contract. But let's use round numbers here. Let's say the index at the moment is $15,000. As we said before, an index option has a 100 multiplier on the index value itself. So if the index value is currently at 15,000, that is a $1.5 million notional contract. That, in my opinion, is out of the range of most retail traders, if not nearly all retail traders. This is purely an institutional product. So when the exchanges are well aware of this. The exchanges realize that some of the products that these proprietary index options that they offer are only suitable for retail for institutional traders. Over the last few years, we have seen most of the exchanges that offer index options build these sort of smaller size contracts specifically catered to retail traders. So for example, when we look at the NASDAQ 100 index complex, you have your full value NASDAQ 100 index, which is represented by symbol NDX. That's a 100 multiplier on the full index value of 15,000, which is a $1.5 million contract. And when we talk about these full value indices, index options, these are the ones that offer both AM and PM settlement. So the monthly options are typically AM settled, and then all the other weekly and daily options, and yes, many of these options now offer daily expirations. You can trade the options that expire every single day, going out usually about 30 days or so. But the monthly options on the full value index options are those AM settled options. And those are the ones that I think for a lot of retail traders, you generally want to avoid trading. I don't particularly see a great reason for retail traders to trade those types of products. But even then, even with that, this is the type of product that I typically are out of the range for a lot of traders. And if you think about the S&P 500, that's a $5,000 contract. Multiply that by 100, that's a $500,000 notional value, the full S&P contract. So $500,000 for the S&P, $1.5 million for the NASDAQ 100. Most of these contract sizes, I would say, are out of the range for a lot of retail traders, which, like I said, which is why these exchanges over the last few years have started to list smaller value indices or just smaller multipliers on their index options to make it more suitable for retail traders. So for example, the NASDAQ exchange has listed both NQX and XND. NQX was a 1/5 of the full value index. So when the NDX is trading at 15,000, the NQX is trading at 3,000. So instead of a $1.5 million contract, this is now a $300,000 contract, which for many traders, that still might sound too large, right? That's the equivalent of trading, there are not many stocks that are trading in the $3,000 range. The only one I could think of is probably Booking.com that's trading, a couple of $1,000. And, that's not a widely traded product by retail traders because of the size of those contracts. So those also offer AM and PM settlement for the NQX product, but I think the product that most retail traders should be focused on is the XND product. That's 1/100th of the value of the full value index. So instead of trading at $15,000, it's trading at $150. Multiply that by 100, we're talking about a $15,000 contract. Now that is in the range for most traders. That's in the realm of, let's say, Apple stock or some of the stocks that are trading, around $150 to $200 or so. And the great thing about these new sort of what they call micro index options is the fact that they are all PM settled. These are products that are built for retail traders, so they don't even bother listing AM settled contracts. They're all PM settled. They're meant to kind of mimic what trading an ETF option feels like from a sizing perspective, from a contract specification perspective, but at the same time, they offer that European style cash settled nature of index options in the size that's more suitable to the ETF. And lastly, we'll compare that to just QQQ, which is the most popular ETF that tracks the NASDAQ 100 index. At the time when the NASDAQ is trading at 15,000, the Qs were around $440. This XND product, the 1/100th size index option, is nearly about a third of the size of QQQ. So even QQQ in this particular example is a $44,000 contract, which for many retail traders, you might be able to trade it, but you might not have a lot of flexibility in terms of sizing, right? You might only be able to trade 1 or 2 contracts. You certainly can't trade half a contract, which is where I think XND really steps in, because it provides you with the size that you might want from an ETF option. And in this particular case, it's actually even better flexibility from a sizing perspective, yet it provides you all of the other benefits that we talked about that an index option provides, such as European cash settled nature.
Tony, this is a great slide. I think that really, double clicks into, well, in this case, the NASDAQ 100 index, and you called it a complex, so it's an interesting way to frame it, but I think it totally makes sense. And I think you've talked about why this complex was set up, right? Largely to appeal to a broader set of investors, and in particular, more retail investors, where it's just more accessible to them in terms of some of the costs. So I think that makes a lot of sense. And I imagine this type of complex probably applies to other key indices like the S&P 500, for example. So encourage our audience to also go explore. You'll probably find similar complex for the S&P 500, for example. One of the questions I have, and actually I'll group 2 together here for you, Tony, is number one is liquidity relatively consistent across the board, or would you note, like, or would you highlight that, there's some nuances? So that's kind of part A. And then part B would be any other call outs for our audience in terms of selecting, which index here within this complex to actually trade options on.
Yeah, great question. So to answer your first question with regards to liquidity, the further you go down in terms of size of these index options, meaning the more they are built for the retail trader, the lower the liquidity we have generally seen in these types of products, just simply because the size, the notional value that's traded in those contracts gets smaller and smaller, right? At XND, you need to trade 100 contracts to match the notional value of a single full-size contract. So as you go further down this in terms of size, the liquidity is not as deep in those smaller contracts as the full-size contracts. And we see the same thing in the in the S&P that also offers same thing, the full-size contracts, the mini contracts, and what we call them the micro or the nanos, or you can consider them the micro contracts, as we do here in XND. And the smaller the size, you simply get smaller, or rather liquidity falls off the smaller the size you go. And to your question regarding, which contracts might you want to choose as a retail trader? Well, one, it really comes down to size, right? What size is your portfolio? Because if you have a small portfolio, you're not going to trade the full size contracts. But from my perspective, the small size contracts typically still have enough liquidity for retail traders to trade. And they also offer the PM settlement, which makes it a lot easier to remember how to manage those trades as you approach expiration. So my choice for a lot of retail traders are either choosing the small size index options or trading the ETF options for a lot of traders. Those are kind of the choices that I think most retail traders would choose. The full size contracts, even the mini contracts in this particular example, retail traders may find that it's too big for them.
Yeah, and I think it's, what's interesting too, it really does come down to what type of strategy you're using as well, right? Like if you're just going long, in this case, the NDX, to your point, pretty expensive, right? But if it's a strategy that is like a credit spread, for example, where you're kind of you're going long and short, and so therefore you're kind of offsetting some of the cost and you're kind of capping your risk as well. I think that's a factor that our audience should consider as well when they're thinking about which of these kind of sub indexes, if you will, make sense for their trading strategy. So thanks, Tony. I think that's helpful, and I think our audience will benefit from that answer. Thank you very much.
Yeah, no problem, Dave. So let's dive into this one important part that I did said that we're going to dive into some examples for, which is the difference between AM versus PM settlement. And this part can be quite confusing for a lot of traders. So I want to walk you through two examples, one of an AM settled option and one of a PM settled option, because we have to understand one, when they can, when the options are settled from a price perspective, but at the same time, we also have to understand when is the last opportunity to trade these options, because those are two different things and they might fall on two different dates. Not very common of what we're used to when we're trading stock or ETF options. So let's take a look at the first example here. Let's say I was to buy a SPX April 20th AM settled option. So an option that expires on April 20th, but it's an AM settled option. And this is a 1550 call option. As you can see, the settlement price, meaning when the option will be settled from a cash settlement perspective, is not on the closing price of that day, but on the opening price of that day. That's what the AM settlement's referring to, is instead of the closing price, it's the opening price of that day. But because it's settled on the opening price of that day, what that means is that the last time you can actually trade these products is on the close of the previous day. And what that means is that even though the last time you can trade it is on the close of April 19th, the option contract isn't settled until the opening price of the very next day. And some things can happen overnight. Macroeconomic events can happen. Maybe a big earnings happens and pushes the index higher or lower overnight. Whatever that could happen overnight could be, will be reflected in the P&L of your trade. And this is what we call overnight risk when you're trading AM settled options that you simply don't have when you're trading PM settled options. So this is something that I think is important to be aware of. And for this very reason, I actually recommend that most retail traders to not trade AM settled options, because you have that overnight risk, and it's a risk that I just think that most traders don't need to take, because there are plenty of options that are PM settled, and the AM settled options only expire on the monthly options. And especially when you're trading the smaller size contracts, they actually don't offer these AM settled options either. So if you are trading the full size contracts, I tend to say trade the PM settled options. The AM settled options have this overnight risk that you have no control over. You can't trade it, the last day you can trade is the day before, and you just have to hope that nothing big happens overnight. And that's a risk that I think for a lot of traders, it's not one that they necessarily need to take. Versus a PM settled option, for example, if we buy an SPXW, which are the weekly options that expire on April 27th, these weekly options are all PM settled daily, and weekly options are all PM settled. These are just like your stock or ETF options. The settlement price is based on the closing price of the expiration date quoted in the option contract, and the last time that you can trade these contracts is up until the closing price of that expiration date. So much easier to manage, because the last day that you can trade them is the date that's listed on the contract, versus AM settled options are based on the day prior to the date listed on the contract.
Thanks, Tony. I was waiting until we might get a bit deeper into AM versus PM settlement. And I think you've done a great job here to kind of explain it, and that in most cases, probably the PM settlement is going to be a little bit more appealing for our audience. So thank you for going a bit deeper there. That's great insights.
Yeah, you're welcome. So let's take a look at an example here of an index options trade. And we're going to use a simple long call option just to help illustrate these cash settled options and how they would work for your account. So let's say the S&P 500 currently is trading at around 5150, and I look at buying a 60-day at the money call option for, at the time, $130 per contract. Because these are each 100 multiplier, that means the notional value of this contract is $515,000. And I would pay, in this particular case, $13,000 for that contract, because the index value, I have to multiply that by 100. And just like a call option that you purchase on a stock or ETF, what you lay out in terms of premium, that's going to be your max risk. In this particular case, $13,000. My maximum upside here with any call option is unlimited, because the index can, in theory, go as far as infinity to the upside. There's no limit as to how high a stock or an index can rise. So a call option in this particular case has unlimited upward potential, while I'm risking in this particular case risk that's limited to $130 $13,000 per contract. And the break even here in this particular case is at 5280, because that's the 5150 plus the $130 that I have to pay. That's the 5280. That's my break even price. That means that the index has to exceed 5280 in order for the call option to be profitable at the expiration date. So if it's above that level, I will see profits. If it's below that level, I will see some level of a loss, anywhere between $0 to $13,000, depending on how far away I am from that break-even price. So let's take a look at how this trade ages as we approach expiration for different scenarios. So in the first example, let's say I buy this 2-month 5150 call option on SPX when it's trading at 5150, and let's say the index at 60 days later settles at 4,900, meaning it declines $250 from the price at which I purchased this call option. This call option is now out of the money at expiration, which means that just like any other call option on a stock or ETF, it expires worthless. And at this particular case, I effectively have $13,000 debited from my account. Now, the debit happens at the time that I open the trade, so nothing actually happens at expiration. This option simply expires, and I lose the $13,000 that I paid initially to get into this contract. Now, let's say 2 months later, the index ends up at 5150, basically at the money. So at expiration, the stock is at 5150. And in this particular case, an option that expires at the money is also unfortunately worthless. So the same example as before, if I buy a call option and the index doesn't move, it just stays where it is, it's at the money. At the money options effectively expire worthless as well. So in this particular case, I would lose also $13,000. Now, in the last scenario, let's say the index does rise, in this particular case, $250. Now, my call option that I've purchased at 5150 is in the money by $250. In this particular example, I will be credited $250 times 100, which is the multiplier for the index option, which means that I will be credited $25,000 into my account for this trade. And what that means is that at expiration, even though that the call option is in the money, I won't have to take physical delivery of the underlying security, such as what I would do if I had bought this call option on, let's say, SPY, the ETF option. If I had bought SPY options that expired in the money at expiration, I would be auto-exercised and I would own 100 shares of SPY at expiration. Here, I don't have to worry about that physical delivery. I'm simply credited $25,000 into my account at expiration, minus the $13,000 that I initially outlaid to get into the trade. My net profits on this trade would be $12,000 on this trade, and I would simply have effectively $12,000 credited into my account as a result of that, as opposed to taking physical delivery of the underlying security. Then I have to sell the security in order to realize my profits. Here, with an index option, the transaction is much cleaner, and my total profits at the end is simply just deposited into my account at expiration.
Can I jump in, actually, Tony? Because I think this is a great slide to kind of illustrate, obviously, like a trade example. And I think the other thing that's interesting is, going back to that NASDAQ 100 options complex that you presented, right? We're seeing values here for outright buying the NDX, right? But XND, for example, and you can check my math here for me and validate it, but XND being 1/100th of the value, for these scenarios, we would essentially just divide these figures, I imagine, by 100. So if you were using XND, instead of a minus 13,000, if it falls out of the money, it would be $130. Am I doing the math right, Tony? And similarly, if it were in the money at the example given here, instead of 25,000, it would be 250. So I guess that showcases really the power of, and the value, frankly, of that complex, and how broad that range really is. Is that fair? And did I get the math right? Can you validate that for me, Tony?
Yeah, that's exactly right, Dave. You just basically take all the numbers you see on your screen, you can divide it by 100, and that's exactly what you would get. Instead of a 5150 contract, it'd be $51.50. Instead of $4,900, it'd be $49. And like you said, the P&L, you just take those numbers, divide it by 100. So $130 loss and maybe a $250 profit, as opposed to $13,000 and $25,000. That may sound scary in terms of size for a lot of retail traders.
That's great. Well, again, it speaks to the power of that complex and how there's a lot of options there for our investors and our audience. Thank you, Tony.
Yeah, thank you so much, Dave. And with that, that concludes what we wanted to share with you here today. I really hope that this was helpful in giving you an understanding in the deep dive of the true differences between an ETF versus index options, which on the surface looks very similar, considering they effectively track the exact same index. But when we look at the actual contract specifications of those contracts, they are quite different from each other, and they offer differences in terms of how they're settled, when they can potentially be exercised, and those can make a big difference when it comes to the actual trading of these products. So make sure that when you trade some of these products, you read the fine print, you understand the differences between these contracts, because both of them can provide some great benefits in terms of helping you get exposure to some of the most popular indices that you like to track in your daily trading. With that, thank you so much.
Well, thank you, Tony. In terms of an introduction to index options trading, it's a lot. It's a lot to really unpack, and I think you've done a wonderful job. And the slides as well really help to highlight the nuances between European style and American style, AM settled and PM settled. I think you've done an awesome job to really unpack that. Lots of great content in the slides, and I'm sure that our audience will really enjoy this. So a big thank you to you once again, Tony, and a thank you to our viewers and our audience as well. And we look forward to having you back, Tony, because I know we have more webinars planned. And I believe what's up next is going a little bit deeper into understanding options Greeks. So that should be a very interesting one as well. And if you found value in this one, I'm sure you'll find value in that one. And one last reminder to our audience that all of the webinars in this series are available within our education hub. So if you like this one, please go there, check it out. We've got a number of different topics that we've gone deep into as relates to trading options. So big thank you once again, Tony, and a thank you to our audience. We'll see you next time.